Alright, good afternoon everybody. I want to go live here a minute early because I'm holding a position into an earnings report, so I want to be able to watch and manage it. So let me get this disclosure out of the way so I can get it off my screen. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. While my trades are placed through T3 Trading Group, you should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure. I'm holding some path into the earnings report here. Not too much though. I'm really pretty light in it. This space between $20 and $21 in path has been my price target in this thing forever, and we're there. So I have a very little bit in it. I think the options market's pricing in like a $2.15 move. This thing sometimes trades really crazy on its report, though. I've seen it move much bigger than what the market's priced in for it. So I'm assuming that's coming out at 10 after 4. So like I said, I just wanted to get this meeting started. Actually, I'm going to do that. Dell is out, Marvell is out, Ulta is out. I think I saw Marvell was trading down. Should be about 45 seconds here for me. That market ripping to the close. Wow. Wow, wow, wow. We finally had a weekday, all day, and then we had imbalances come out. Now I got some pretty nice downside tails from this market on the daily chart. It's path trading up here, 25 cents or so into its report. Should hit in 10 seconds. I got some bids out, I got some offers out, I know what the measured move looks like. There's a quick downtick. Thank you. Solid beat on EPS, 12 cents versus 7-cent estimate. Revenue's a beat. We need to see guidance. Still basically trading where it closed at. I see Q4 revenue. It looks like it's basically in line. Stock's upticking here a little bit on that. Okay. Annual recurring revenue. Okay. Stock's continuing to uptick a little bit. I'm offered higher. I got one offer out. It's above what my target's been. It's actually trading at my target right now, but it's to fully liquidate my position if I get filled there. I'm tempted to just whack out of the position here because $21 has been my spot. But the options market's telling me maybe I can get a little bit more. Maybe you should be a little bit greedier. $44 high right there? Was that really the high? There we go. I got filled. I'm all out of path. Boom shakalaka.
What did they say in the dojo? Let's go, champ.
Let's go, champ. Nice little move there. I will be looking to rebuy a dip on this one. Yeah. Yeah, this was a good move. I was able to catch. I like how the stock trades too. It's the biggest thing. I remember watching this thing like way higher, and that's I think when Kathy Wood started buying it, and I was just trying to be patient and be patient and be patient because we had so many of these stocks IPO back in that bubble territory that just opened up at ridiculous prices. The other one was Unity. I remember watching Unity for a while and being really interested in it. I was just like, not at these prices. Because UPath was trading up in the 80s at one point, just completely insane. This Unity had traded above $200 at one point. I'm not interested. I'm not interested in $200. but you give me the stock in the 20s and I'm interested. Or path, same deal. You give me this path in the teens, I'm interested. So I will continue to keep an eye on this one. I'm actually going to sneak a couple small bids out real quick in case it dips. In which case Joey Diphard will come into full effect. I don't think you guys know who Joey Diphard is. It's before your time. You might be able to still find him on YouTube though. Alright, cool. We'll keep an eye on that. That was Kathy's best month ever. Interesting. And I think that we finally saw people were lightening up on ARC for the first time ever, like 2 months ago or so. All right, let's jump into our normal meeting here. All right, so the SPYs are still trading about where they closed. They're up 0.37%. The Qs are down 0.3%. The IWM is up 0.3%. So we got some outperformance from the Russell compared to the NASDAQ today. I always love to see that. The Dow was a monster today, though. Up 1.5%. Yeah, 1.5% move on the Dow. But, you know, when you've got CRM up 9% and... What was the other one, the big one that was moving this? I thought it was Humanity, but Humanity's only up 0.5%. No CRMs in the Dow, it's up 9%, so that was obviously helping. Oh, UNH, thanks. UNH up 3%. That helps. Boeing up over 3% as well. I didn't look at Boeing at all today. Wow, great continuation higher in this Boeing. Really nice move. I remember I was asked about this stock so many times, this down move, and I was like, I don't like it, I don't like trading it, I don't like trading it, I don't like trading it. And it was only like somewhere in here, I think in the beginning of November, that we actually called it out, I think, for a potential long. I think we got an upgrade down there or something. I thought it was a good, you know, breakaway gap on that upgrade. So yeah, nice move from Boeing. But let's shoot back over to the market. Let's look at the SPYs and the Qs. So I feel like this daily candle here is deceiving a little bit. I mean, it's obviously not, because the price action is the price action, and we closed really, really well. So what we're actually left with at the end of the day today is a downside tail into the ADMA, just below the ADMA for the SPYs. It's like the second touch of the SPYs for the entirety of the month of November, and pretty much the first touch of the ADMA for the Qs in the entirety of the month of November. Qs were relatively weak today. They broke this first level of support that we were kind of looking at, which was like 388, tailed down into that equilibrium area between the space between the 8 and 21 EMA, and closed with a tail. So on the surface of things here, these SPYs and Qs, they're looking really bullish. You had a push through failure on a bull market yesterday, which usually does lead to some downside follow through. I was looking for a little bit more than this, but there's a very real chance, just analyzing daily chart technicals here, and then we can talk about beneath the surface what caused this. There's a really good chance when you're looking at a breakout failure from yesterday that leads to, you know, some selling in the beginning of the day, but a nice downside tail like that, that's actually all the downside move that you get. With that said, if we turn over to the small time frame here, you could see all day the market was kind of weak. It was one of those days that I've been really wanting to see, though, where RSP is outperforming SPY. So the RSP was pretty much green all day. The SPY was hovering around the flat to negative mark for most of the day. So your average stock that was out there was really outperforming compared to the market cap heavyweights that primarily define the NASDAQ. You could also just see that if you look at the IWM, which was green and positive and relatively strong all day. We had been talking about on this daily chart this IWM wedge potentially breaking out, which just did in a kind of a failure of a way yesterday with an upside tail. Like, can this go and have the Qs and SPYs pull back? And the answer is yes, it definitely can, but it's been a really difficult trade if you've been looking for that. I've been looking for that. I haven't gotten it. I feel like I was correct overall on the direction of the move, but not as correct on what the leadership would be over the course of the month of November, because I thought that with TLT on the rise, things like KRE and small caps and mid caps would probably be the best performers on that, and maybe it would lead to a little bit of rotation out of your Apples and Amazons, and that part really wasn't accurate at all. The IWM has been weak, but again, can there be some mean reversion? That's been a theme that we started talking about as of a morning meeting just a few days ago. Well, we've been talking about it a lot, but it got rekindled in a morning meeting a few days ago, and in Pat's note, he had information in there that was showing you basically the performance spread between the NASDAQ and the Russell and how kind of insane it was. I think it was coming from one of the big banks analysts. It might have been Goldman, and that they were predicting that that would retrace. And I was saying, I think so too, but at this point it might become a 2024 theme just because of the tax implications into the end of the year of coming in and actually buying the losers in December and selling the winners. I don't know if that's really going to happen at this point. But we started to see it a little bit yesterday and then into today, where there was relative weakness in the NASDAQ, and the IWM was holding up better, so it got me a little bit excited. So we wanted to see, can that IWM hold in, and the Qs were weak. And again, the answer was yes. Qs here, this 5-minute chart of the Qs, you can see that we were just really, really weak in the NASDAQ all day. A lot of those names, I mean, Google was atrociously brutal during the trading session. Amazon was really weak pre-market. The Amazon price action was actually kind of wacky. Apple was stronger, but eventually lost the 189 level that we were looking at on an intraday basis. So, pretty interesting price action here overall. And then just when you think that you're actually going to get kind of a weak close for the NASDAQ and the SPYs, I was still looking for a little bit more of a down move. I want to see if I can get a down move to like 383 in the Qs. That's kind of my target-ish on my TQQQ position. And on the SPYs, looking for a little bit more here also. I'll be out of the SPYs more quickly into a down move. But 450 in the SPYs I was thinking was appropriate, especially, again, if we could have gotten another weak close. And just when you're thinking that you're getting it, we had this insane rip into the close as MOCs hit. Now, it's the last day of the month, so this could be some window dressing, some performance chasing, whatever it is that caused this massive rip. And again, this is sometimes the wacky price action you see on the last day of the month. So the question that I have that I don't know the answer to is, well, now I'm actually looking at a market that just gave a bullish downside tail after a failed breakout. There's a real chance that, even though I was looking for more, that this is it. You pulled back into equilibrium, you create your pivot point, you shake some people out, and then you can potentially begin to continue higher. Kind of similar for the SPYs. I don't know how many people are actually getting shaken out, but probably a few on the break of these lows from a week's worth of trading now. 453.50 was that low from a couple of days ago that broke intraday today. They did support this ADMA on the daily chart as well. So the question is that it? And now, we certainly need to continue. The key pivot high in this market, very obviously, is yesterday's high, when we had our first kind of down day, sort of. I know on a percentage basis we didn't really finish down, but from highs to lows, it's like our second seriously red candle of the entire month. That high is your main key pivot high. Or sometimes what we see is when you get this kind of buying into the close that's happening off just kind of positioning and rebalancing or window dressing, at the very end of the month, sometimes you see this almost get immediately negated on the next trading session. So that's the big question. I don't have the answer to it. So we'll wait and see. Key price points for moving forward for tomorrow and for early next week right now are going to be today's low and yesterday's high. Those are the spots to pay attention to, big picture, and whichever way we break, if we break today's low at some point tomorrow or early next week, then maybe you're getting some follow through to a little bit closer to those price targets I've had in a price corrective environment, which would be like SPY 450 and QQQ 383. If we break highs, the bull market is on. So that's all you got. I had been saying, and I'll just continue to reiterate my thought process, is that I thought we were due for more price and time correction. That thought process has been correct thus far, but I still think that time is a bull's friend. And the more time that goes by with corrective action, whether it is through price or time, the higher the probability that we actually begin to work our way up again and maybe go into a little bit of an upside grind into the end of the year. So that's kind of the update on the big picture. On the small picture, my game plan today was to primarily focus on position management because I still had these relatively large positions in the Q and SPY levered ETFs coming into today's trading session, and I was looking for downside follow through. We did communicate in the morning meeting actually as we were scrolling through some of these big tech stocks. I felt that some of these could have been shorts. I didn't actually take any of them as shorts, but the trades were there. I think in the morning meeting we mentioned Apple 189 as a short spot, but then during the actual trading session, we called out Apple as a short versus highs when it kind of came back through 190 at the beginning of the second bar here. That turned out to be an okay trade. Even though I ended up buying small Google today, I think we talked about looking for Google downside continuation maybe through 135 into the 132 area as a spot where you could potentially look to begin to buy as there's a gap fill down there. Amazon was much tougher. I think Meta we talked about could get some follow through. Nvidia we certainly talked about as a short through 476. I think Josh might have been involved in that trade. I'm really not sure. But I know it was communicated by him in addition to being communicated by me. So there was actually a decent amount of short setups that were out there that you could have focused on. As far as in-play names go, I didn't really have that much. I wanted to see if this Triple D could get follow through. It didn't. I wasn't involved in it. I wanted to see ASO, right? I think that this one was really interesting. I didn't trade this one either, but I specifically brought this one up in the morning meeting. And guys, by the way, this is where it pays to do your research. I didn't actually trade it. I've just seen this happen before. I've seen this playbook before. The earnings report on ASO was really not good. Missed pretty much across the board. Guided lower, but announced a $600 million buyback. Do not underestimate the power of very large, new, especially if they're somewhat unexpected buybacks. $600 million is... I did the math on it pre-market when I was doing my research just because I thought that this was an interesting trade setup. And I honestly, I didn't write it down, so it was all in my head. But I think I figured that means that at that price point, they'd be buying like 13, 14 million shares, but the float 73 million. It's a pretty significant amount of a potential buyback. If it's again that's at that price. If it moves higher, it's based on a dollar amount, so they'd end up buying back less shares. But I thought that was significant and on a terrible earnings report, but because of that massive buyback, again I didn't trade it. But this is really what I thought could happen. They bought this thing all the way back up. So that's why I said that this one was going to be worth watching today. I got caught up with some other things. The only thing I traded I traded very, very tiny Google. Honestly, I bought it at 132 on the way down. Plan was to build in on this thing or build back into it. For anybody who hasn't been here for a while, I've been in Google for a while. I did really well with it. I fully liquidated my Google position into these kind of upper 130s, and I've been looking for a spot to rebuy it. I thought 132 could be it, but sometimes with these kind of bigger picture positions that I get myself into, especially when I'm already up a lot of money in it, I like to create a strategy where I am risking basically the money that I've made in order to be able to make more, and I can do that with a very loose rope and build into positions kind of small over time and kind of work the trade and work the position for cash flow on a day-to-day basis while I potentially hold a core position. So I never took any Google short today, but when it got down to 132, I just nibbled in. But again, my plan on that was very big picture. I was very tiny in the buy. I never added anywhere below 132. My next bid was at 131 to buy some a dollar lower. And when it ripped back up above 132 in that closing move, and I'm still just a little bit nervous about some rotation out of big cap tech and a deeper pullback in the NASDAQ, I said, you know what? I'm just going to liquidate my position here for, what amounted to a little bit, basically break even on the trading day for it, and just kind of move on and reassess the position tomorrow. And I'll potentially get back in at that same price tomorrow if it gives me opportunity and I like what I see, but I'll be doing it small. What I traded more aggressively today was these Chinese names in the morning. JD, I bought JD at 27, but I've already been in this thing. I've already been swinging it. I already have some size in it, so I didn't do anything in JD new that was too aggressive. Just a little bit of new buying around that $27 area. Alibaba, which is a new position for me, I took a lot more aggressively. I bought Alibaba on this day back here on the 28th of November, and I thought it was a solid intraday move. It closed on highs, nice downside tail. It closed back above the support, but I decided just to liquidate it anyway, primarily because I didn't have a massive profit cushion because I had taken an intraday loss, and I didn't really want to add a new long onto my portfolio, especially when I already had the JD exposure. So I got lucky to not be involved in this big gap down that happened the next day. And I just want to reiterate what I said earlier about these Chinese ADRs. It's unfortunate that they've become so difficult to trade. These used to be phenomenal day trading vehicles and swing trading vehicles. Now they're really, ever since they created those Hong Kong listings for these stocks so that it trades overseas, it trades more like a normal ADR. So I generally, as a rule, avoid trading ADRs because the charts kind of look like this. Look at like Toyota as an even more extreme example. This thing barely really has any intraday range, and then we'll have these massive gaps all over the place based on how it traded in Japan. That means that I can't manage my position properly. I can't trade in and out of this thing. I can't trade it with size. I can't really do anything with this. Now, Alibaba, JD, their Hong Kong listings made them more like Toyota than like a typical American stock. They used to just trade like American stocks because they weren't listed anywhere else. But it's not as bad as Toyota. It's not as gappy as Toyota is, or honestly a typical ADR is, but it doesn't trade as smooth as obviously Apple does. But believe it or not, for anybody who's a newer trader, Alibaba used to trade as smoothly as an Apple did, even though it was an ADR. It was only actually listed here. So it's just made these things so much more tricky to trade because exactly what happened a couple days ago is what can happen in these stocks. You get this great looking technical close here, you think you're looking okay on it, and then whatever's going on overseas in the middle of the night, next thing you know, you're faced with a really big gap down. But today it's kind of like a day 4 to the downside here. It's even more extended from these moving averages. I still also really like the company fundamentally. And then this kind of high volume hammer came in with Alibaba and JD at the same time, and I communicated them, said I like the trade there. JD ended up being the much better name to be involved in. This Alibaba's just been incredibly heavy for quite some time, but it ended up kind of being a pretty good hammer. The initial risk on the trade was very low. My average price was like $74.25. Really was just versed the low of the day, which was 74. Struggled to get my one-to-one kick at like 74.50. Eventually got it. Got a little bit of follow-through. Got a decent close. I honestly would have preferred to close back above 75 to give me a little bit more conviction, so I sold a little bit into the close. But now we'll see, and I'm certainly at risk of a situation happening like what happened yesterday, but at these prices, with the size that I have, if I get a big gap down tomorrow, I'll deal with it. I think that the discount that this stock is trading at is kind of crazy. With that said, it did trade, to as low as like a 50 handle back in October. So, a market can remain irrational longer than I can remain solvent, right? So risk management is always going to be really important and is the key to success in this business. I think that covers everything that I have for you guys today, from big picture down to small picture with my trading and with some of the stuff that we were communicating as a team. I am happy to take a look at anything that you guys have, any questions that you guys have. I also want to point out, we have a handful of guests who are in here from when I was speaking on Benzinga on Tuesday morning. If you're one of those people, I can see you. I have like admin access. I can see all 102 people that are currently tuned into this afternoon meeting right now. Don't be bashful. Don't be afraid to ask questions here in the afternoon meeting. That's what this afternoon meeting is for. It's to help all of us become better traders. And a lot of you don't know me very well. So if you have any questions on how I trade or how my charts look or anything like that, don't be afraid to ask it. I would also say that separately, myself or one of my partners over here has emailed each one of you individually just to get a little bit more information about who you are and what your background is as a trader. So make sure that you are also checking your email, and you probably have something either from myself directly or from one of my partners and associates over here. All right, with that said, let's take a look at any questions that are in the VTF. PagerDuty report also. PagerDuty trading up, looks like, after hours. First thing I'm seeing here is from Michael. Dio, I followed you into Google long off lows. I got stopped out, but I had a plan and stuck with it. The risk was managed and defined. Happy, and I will use it again. Thanks. Perfect. That's all we can do, right? All we can do as traders is create game plans, and those game plans need to define our edge. And it's the consistency in how we trade those game plans that can potentially breed consistent profitability, provided that your edge is sound. And then you want to refine those game plans around that edge over time as you draw in more data. So as you assess any trade, I was just speaking to Dimitri about this offline just yesterday. I know he doesn't mind me calling out our conversation a little bit. When you're assessing any trade that you get yourself involved in, you don't really want to assess the P&L, you want to assess the process. Was the process that I did correct? Is this repeatable? Is this going to make me money in the long run? If the answer is yes, and you followed that game plan with discipline to the letter of your game plan, that's called doing a good job regardless of the P&L. What makes this business difficult is that sometimes we can do all the wrong things and make money, and we can do all the right things and lose money because we work in a game of probabilities. So it's really easy for us to kind of get into our heads. But if you had an appropriate game plan on your trade and you followed it, that is really all we can do. So awesome job, Michael. Keep it up. Dennis is saying there's a bit of an outsized push on the SPYs versus the yield and the dollar move. The VIX seems to be working again recently. I am staying skeptical and open-minded for another move down or at least more rotation. I'm in the exact same thought process as you, Dennis. I love it. From Rex, I tried trading Snow this morning. Okay, earnings name today, Snow. Stock can trade kind of crazy sometimes. One was, you said $9.50. I'm assuming you mean the time of 9.50. At 9.50, the inside 5 when it came back down to the opening low. So created the opening low here, then you have an inside 5. The inside 5 breaks up. I like this trade. It fails. I like this trade. I like a trade that I like on earnings names when they're strong and they gap up, or on the short side if they're weak and they gap down, is looking for the trade setup on the first test of the ADMA. Whether that's via time correction where it's gone sideways and the ADMA eventually catches up on the 5-minute, or it's through a price correction like this was, looking for a pivot signal. A pivot signal could be a big downside tail on an ADMA with a nice hammer candlestick, or in this case, and this is another setup that I like, the weaker candle followed by an inside 5, then the inside 5 breaks up, and you buy the break of that inside 5 versus either the inside 5 low or the actual pivot low. I like the trade a lot. I think that this is actually a really solid, consistently profitable trade in a lot of these big gapper earnings moves, but it didn't work here. So you got stopped out as the market made a red candle at 10 o'clock Okay, so that means you just use the inside 5 low as your stop. That's just fine. Then I gave it another try at 10:30. Okay, when this hammer came in at 10:30. When the 15-minute ADM I caught up. The 5-minute candle also gave decent volume hammer candle, and you got stopped out of that one also. I thought that they were both worth taking, as the Snowners report was good. Can you give me some thoughts? Sure. So I love the first trade. The second trade, I get it. Look, I get it. For me, with these types of earnings moves, it's more of a momentum move for me. I don't really want to trade off a full 15-minute correction, because by the time there's a 15-minute correction, I'm asking myself, why was there a 15-minute correction? Unless it's because this first trade off the 5-minute worked so well that then this thing is getting stuck at $193 until 1 o'clock in the afternoon, and the 15-minute finally catches up. And in which case, I'm still not going to trade it, because I'm not going to like the time of day. So for me, it's more of a, one shot and done usually. If I'm taking that sort of trade, it's going to be based off the 5-minute. Again, I get your trade. I don't dislike it. It's just, for me personally, I think the probability becomes a little bit lower at that point. You want your earnings moves to be giving you momentum. The problem is, like, chasing also. I don't like to chase. Like you could argue, and there's momentum scalpers out there that probably do this. Like, I know Pat has a trade that he likes to look at, where he looks at the first 2-minute bar of the day on earnings names and does like just a 2-minute bar breakout or breakdown on an earnings name for momentum. That I think has provided him some success in the past. It's not a trade that I've ever gotten involved in. I don't really look at 2-minute charts. So there can be some pure momentum players out there that can try to get this. For me, I like to balance looking for momentum but not chasing price. For me, this is chasing price because of how extended the 5-minute is. Whereas here, I got a price correction, but there's still plenty of time for this to do momentum. And we've all seen the circumstance on an earnings name where you get the quick pullback, snap into the ADMA, and then off this pivot low, within 15 minutes, the stock's making a new high and it's just ripping higher. That's the trade I'm looking for there, and I like what you did. Bottom line, higher time frames have 0 lower highs and lower lows structurally. Talking about the market, I assume. I think there was one. I think there was one in November. I count, even though it was a 2-day move, the 11.9, 11.10 as a higher low, higher high. But otherwise, this market has not. I was talking about this in an afternoon meeting the other day, which has been the difficulty of the month of November. The easy part of the month of November, I'll just say it again. I had a fantastic month this month. I hope you guys did too. It entirely came from the conviction at the very end of October, though, where I, said I got super, super heavy. Then this move came in. I was the longest I've been in a couple of years. Caught that move. It was fantastic. If you didn't catch that move by having the stock at that time, this is actually kind of a tricky trading environment. There's no setups here in the market. It's just straight up. This is the only pivot low, higher high of the entire month. I don't count these really because they happened so extended from the ADMA. There was no real equilibrium catch up. What we talked about was that this is like a better trading environment for an uptrending market where you're actually getting flags, the ADMA catch up, technical pullbacks in equilibrium, higher lows, higher highs. It makes for a much more technically tradable environment. November was just, we're going up. Are you in or are you out? Which, luckily we had to focus on being in. So, scrolling through here, next I'm seeing from Dave. You just threw out some levels of interest in your market review. Are you thinking that the high and low from the past 2 days are that clear of a signal for bull market on or bull market off in the biggest picture? No, not in the biggest picture. In the biggest picture, I don't think that a break of today's low means bull market off. I think that a break of today's low means that the bull market is taking an even bigger pause. That's my thought process at this time until the price action shows me something different, right? We can always adjust, and the further out you go time-wise, the more open you need to be able to adjust based on new data that comes in and an update on what the technicals look like. My thought process as of right now is if today's low is broken, it just means that we're getting a bigger technical price correction, not bull market off. Just look for the setup, look for the actual dip to buy at better prices for a lot of things that have been out there that have given huge moves. Break of the high though, and then yeah, I would say bull market on. But I think I still think that if we do move higher into the end of the year, it's not what we saw in November. It's a grindy outcome through the end of the year. So we'll see. Thanks for the question, Dave. From Rich. I wanted to get your thoughts on two different types of setups. I think the RDR or DOO is typically a better setup for extension trades than an inside and down or up bar in the opposite direction. I would agree with that. Inside bars are better setups for risk, reward, and probability of success for continuation trades. I agree with that also. That is I 100% agree with what you just said. I 100% agree with what you just said. I think that what I always say is that inside bars are an execution setup for when you like other things, and they should be primarily with trend or with momentum trades. Every once in a while, there's a setup where it could be counter trend if it's happening like after like a high volume hammer, and then you get in the inside bar that breaks up, or after a higher volume shooting star, and then you get the inside bar and it breaks down. Every once in a while, you could try to take it counter trend, but otherwise, it's really meant to be a with trend trade, and with trend trades are my preference. The RDR, red dog reversal. I wish you would call it red dog retracement, but it doesn't sound as cool, or what you guys have called the DOO, the Oldensmith overthrow trade, which I still think is hysterical. That is a counter trend trade. That is a counter trend setup. So you're looking for the movement to come in the other direction in on a day 3, a day 4, a day 5, a day 6 to then go in the other direction. And it's a very clear entry point and stop loss and understanding of risk reward and a snapback to the ADMA. And again, really technically, you're not looking for a reversal, you're looking for a retracement, and then you want to have rules in place for how your retracement can become a reversal. That's what I try to do. So appreciate the question, Rich. Yep, I see your rephrase there. It's perfect. Dimitri giving us a cool chart here. Everyone should check that one out. Bad process, bad outcome, poetic justice. I love it. Love it. I wanted to validate this is a follow-up from Rich. I wanted to validate my thought process. I was thinking back to last Wednesday's QQQ inside 5 and down on the third bar of the day. I took it and I did well, but you were selling stock higher on the previous bar. Cool. From Jim, how do you personally size positions in relation to your account equity for scalps, intraday swings, long-term swings? Sure. So it's a great question. How do I do it personally? So it's not a question I've been asked in a while, so I'm just trying to review my process real briefly in my head as I answer the question. Let me answer it first in more what I think traders should do, like what I would tell people to do, and then I am happy to, as I analyze that, see if I actually do it different. One of the really difficult things about being both a trader and a trader kind of manager, and I manage over 125 traders at T3, so I manage a lot of people at this point, and I feel responsible to help people to be as successful as possible. Is I don't always trade in kind of the way that I would preach, and whenever there's a difference between the two, between what I actually do or did personally in a certain circumstance versus what I would teach someone the air quotes right thing to do is, I always want to kind of highlight that. Like, hey, I think that this is actually the perfect right thing to do, but actually this is what I did, or actually this is what I do, something like that, if that makes sense. So position sizing needs to be based on how much you want to risk, which needs to be based on your account size, right? That's kind of a very broad initial answer. What I tell people to do, first of all, is to come up with an amount that is a percentage of their account that they are willing to risk for any given day. And what that number is we call a limit down. So what that maximum amount of risk that any trader should do in a day is going to depend a little bit on how aggressive of a trader you want to be, how much experience you have, and to some degree your account size. I think that 3% is very appropriate. I can see arguments for less, and I can see arguments for a little bit more, maybe to as high as 5%, not more than that. I think it's irresponsible for traders to risk more than 5% of their account in any given trading session. I don't care how good of a trader you are, you will have a bad day, you will have days where you read the market wrong, whatever, and losing more than 5% of your account in a day is irresponsible. So you start by coming up with what the percentage is that you want to risk. I think in general terms, and again, Jim, I don't know you personally, but I'm looking forward to chatting with you tomorrow so I can learn a little bit more. So, don't do what's best for you, like what the compliance disclosure says that I have to read before these meetings because they're on YouTube. But I think that 3% is kind of a good starting number, and then you want to break that down into individual trades. So I like just using simple, small, round numbers in this circumstance to make it easy for everybody, because I've got people who are part of the team who are trading anything from relatively small accounts to accounts that are in the millions of dollars. So I always just use simple numbers, and then if you want and you're working with a bigger account, you can just add a multiple to it. But let's say if you were working with, I don't know, simple numbers, right? $10,000 account, 3% of that is going to be $300 a day. So you can break that down into $300 on average trades that you can take in any given trading session. If you have 3 trades that go wrong for you in a row, you're not seeing the market properly, or something's wrong, and you should shut yourself down. It was just very recently in an afternoon meeting. I don't remember if it was before or after our Benzinga guest joined us. I did like a whole afternoon meeting where I was talking about that the key to success in trading is really within the numbers itself. So we all have whatever this maximum loss should be in a day, and when I review a trader's account at the end of a month, whether it's my own trading for that month or anyone else, I'll just repeat this actually, because even though we did it in an afternoon meeting recently, I think it's such valuable information that we can just kind of redo it. When I look through a trader's account and I know that this person, let's say, did not have a successful month, the first thing I do is I want to know what that trader's maximum daily loss is. Let's just say it's $500 instead of $300, because that was the same example I used the other day. So your maximum loss in a given day is $500. The first thing I do is I scroll down over the course of a month and I see how many days was this trader undisciplined enough to lose more than $500. And most of the time, my work is already done. You want feedback on why you didn't have a good month? Well, it's because of the 3 days over the course of the month where on this day you lost $900, on this day you lost $1,400, and on this day you lost $1,600, and you're wondering why you didn't make money in that month. That's it. Boom. Done. And sometimes it's even more extreme than that. And then the flip side, and by the way, what I just said right there is the number one reason why traders don't become successful. I don't care what your strategy is. I don't care what your approach is. I've been doing this for a long time. I've seen a lot of traders. I've seen a lot of accounts. What I just said right there is the number one reason why traders do not become successful. They do not stay disciplined with what their maximum risk should be on any given trade that they're taking. Occasionally, little bit less often, but it does happen. I will look at a trader's account and that maximum loss is $500, and I say, wow, not a single day where this trader lost more than 500. The next thing I then do is I scroll through it and look at the biggest up days, and I see that this trader never made more than $500 in a given day. Well, now I'm also looking at a trader who's not going to be successful. This trader's not going to have a spectacular blow up. Their risk management is good, but they're not going to make money either. They're going to have a slow bleed out. They're going to slowly kind of just bleed out over time to fees or commissions, or just the numbers just not working. The successful trader is the one who, at the end of every single month, never violates that $500 amount. But then, even if it's just 3 times over the course of the month, has a day that is a multiple of that maximum loss. I'm scrolling through this profitable trader's month. He never lost more than 500 in a day, and there's a positive $1,000 day, there's a positive $1,500 day, and there's a positive $2,500 day. That's it. That's why the person's profitable. So that's why we need to remember that this business is a marathon, it's not a sprint. And this is where the psychology gets extremely difficult for us as traders. We're always super focused on the now. What is my P&L right now? What is this trade doing right now? I can't be wrong right now. I'm down $500 today. I can't be down $500. I'm going to take this next trade. I'm going to make it all back. And now you're the trader that's losing money again because that next trade failed, and now you're down $800 in the day. And you do that every single time you're down $500, you don't stop. Now, once again, I'm looking at a trader that's not successful. I can't emphasize it enough. We spend so much time talking about technical analysis and charting and everything else. That's important. We need to know it. It's not the key to success in the business. The key to success in the business is in the numbers itself. It is exactly what I just described. So you have to remember, like, no matter how bad you feel in the moment that you just hit your maximum loss for the day, what's going to matter is what it all looks like at the end of the month. And I promise that you're not going to remember that day. You're going to, when you go back and you look at your month of trading, especially if you've been doing this for a while, you're not going to remember really that day that you stopped at your maximum loss for the day. What I promise that you will remember is the day where you lost 10x your maximum loss, which I've done. One of the reasons why I feel like I'm decent at working with traders is because I feel like I've made every mistake that you could possibly make. I've done it. I've been, had days where I lost total discipline on the downside, was on tilt, had huge losses. I remember those days years later. But tell you what, if I stopped myself out at what my maximum loss was, I probably wouldn't even remember it the next month. So that is kind of the key to success in the business. That was a little bit of a tangent away from your question. So, first what you do is you come up with what that maximum loss is going to be for the given day, and then you can break it down into individual trades. For people who are brand new to trading, I recommend that they just do it kind of uniform. So going back to the $300 example, you're giving yourself, 3 shots at $100 each. For people who are a little bit more advanced, if you're more advanced, you're probably going to be having more than a $300 maximum loss. But for people who are a little bit more advanced, I recommend what I call risk skew into their trading. As a matter of fact, I think that risk skew as a concept is also one of the keys to making good money in trading. Risk skew is the concept of risking more money in better trades and less money in trades that aren't quite as good. How do we judge better trades from worser trades? Is worser. Brant loves when I say worser. Risk reward and probability of success, right? What is the risk reward? Risk reward is simple math, and then the more dynamic part of the situation is probability of success. And for probability of success, we view probability in terms of layers of probability. We utilize a good risk reward and probability of success, again based on the math of risk reward and layers of probability, to create a letter grade for yourself on any trade that you take. And the higher the letter grade, the more the dollar risk. So now instead of risking a uniform $100 per trade, maybe like what you might call an A+ trade is a trade where you're actually willing to risk your entire day in that one trade. as opposed to a C trade is maybe a day where you risk just a percentage of the average. And then that is going to be how you come up with risk skew. So I think that applies regardless of trade type. Scalp, intraday swings, longer term swings is kind of the same. It's the same concept. When it comes to position sizing, position sizing is the last part of the math. You first need to figure out, based on the type of trade that I'm taking, what's my space risk. Space risk is going to be the distance between your entry point and where you will stop yourself out. That's space risk. Again, just using Alibaba, my own trade today, as an example. My average price on my purchases was $74.25. I kind of took the offer, and then I took the offer some more, and then I bid in some more. So I had like 3 different entry executions that averaged out to $74.25. They were kind of all right in that area. My stop loss is a penny below the low of the tail, so $74 even. I have 25 cents worth of risk. Every 1,000 shares I take is $250 worth of risk. So the question then is, all right, my space risk is 25 cents. How many dollars do I want to risk in it? If the answer is $100, then I'm taking 400 shares. If the answer is $250, I'm taking 1,000 shares. So I think that concept of coming up with position sizing is going to be the same regardless of the trade. If you're talking about the types of trades that you referenced here, it's going to tend to be that what you're calling like an intraday scalp here will have a smaller spacing risk, so therefore you're going to take more sizing for the same amount of dollars, right? Like if you're buying 1,000, if you want to risk $100 and it's 10 cents worth of risk, you're buying 1,000 shares. If you want to risk $100 and it's $1 worth of space risk, then you're taking 100 shares. So that's how you come up with it. And again, the scalps probably will tend to have tighter space risk, and more swing type positions may tend to have larger amounts of spacing risk. A lot of what I actually like to do, and this is actually similar to what I was doing in this Alibaba, I'm not sure what you would personally characterize this trade as, a scalp or an intraday swing or whatever. A lot of what I'm looking for is intraday risk for daily chart reward. So I'm not taking ever this chart in a vacuum. As a matter of fact, I would argue that this chart in a vacuum, I don't even really like it. It's okay. I don't like the risk reward of a snapback to the ADMA on a counter trend move versus the amount of space on an entry to the stop loss. So I probably wouldn't take it at all. Knowing the big picture, I like the entry a lot more. So I don't ever take anything in a vacuum on a small time frame. Any and everything I do is with an eye towards what a daily chart looks like, and it's with an eye towards what the market looks like. So in this trade here, again, a lot of what I want to look for is intraday risk for daily chart reward. Well, what does this daily chart look like? All right, well, I'm day 4 down. The ADMA on the daily is 77. The 21 EMA is basically $80. I consider for my trading, and this is a whole nother lesson or afternoon meeting, whatever, how I utilize moving averages. The space between the 8 and 21 EMA on any chart on any time frame is what I consider to be technical equilibrium for that chart for that time frame. So for me, I'm looking at a stock that's extended. Extension is a relative term. Stocks can be more or less extended. Markets can be more or less extended. But all the same, at $74, I'm looking at a stock that's $3 plus extended from the lower band of equilibrium and $6 extended away from the upper band of equilibrium, basically. So when I'm taking this small time frame trade, like, yeah, sure, I'm happy to sell a little bit of stock to cover some risk at $74.50. I sold a little bit more at $74.75. I sold a little bit more into the close. Just that's not real money to me. That's covering risk. That's more risk management than it is reward. I'm gonna get real money, even if it's a lower probability situation. I don't think it's actually that low. If that purchase gets me a move to the lower band of equilibrium, $77, or that move, or this purchase, really what I'm looking for, I want to see if I can get a snapback to $80 off of this. I have a game plan that I created for myself for this trade for upside reward maximization to hold at least some stock to basically $80 in this thing. That's the game plan that I have. I don't need to be right on this all the time. As a matter of fact, unless it gaps all the way down past my stop loss, which I already said in the afternoon meeting earlier, could definitely happen here because it's a Chinese ADR and I'm willing to take that risk. And I have whole other rules, by the way, for keeping positions overnight and how much profit cushion you should have and things like that. Like everything I'm doing thus far, again, is as far as selling goes, is about risk management. Reward maximization will come from this bigger move. If I get stopped out at $74 tomorrow, as long as it doesn't gap past my out, I don't care at all. I do not care at all. I will do this over and over and over again. And once in a while, I'm going to get that move to $80. And if I'm doing that, my risk reward ratios are going to be naturally fantastic for me, and I'm going to make really good money. So that is what I like to do. Now, I'm trying to think if, for me personally, if I really do anything different than I just described. And I would say that the answer to that is broadly no. I mean, it's tough when you're speaking in these broad general terms because, you know, there's certain types of trades that I'll take in different ways. And again, we don't really have the time to fully go into it, especially because I've spent a lot of time talking about it in previous meetings. And if you join the team, if we get you involved in the team, then you'll obviously learn all this. I have been short the Qs since, which day was that? I can tell if I look at the SPYs. I've actually been short the Qs, the TQQQ, the leveraged Qs, since November 3rd. I shorted SPYs and Qs that day. I was able to get fully out of the SPYs on this day, and I didn't re-enter them until like up here somewhere. The Qs I got totally out of. I never got totally out of, but I covered a lot into this down move. I have a methodology with this counter trend trade, which is also acting as a hedge for me because I was super long at a certain point this month, where I actually don't have a stop loss. My risk is managed through time more than it's through price. It's a little bit tricky for people to do, especially for people to do with smaller accounts, because you don't know exactly how much you're going to lose when you're wrong. You know, I can kind of have a general idea, but the impressive thing to me is that I've been short the TQQQ since November 3rd. I'm basically break even on the trade. So look at this move against me. Look at all the big pullbacks this entire month. There have been none, but I managed that with a certain system that I kind of created based off this moving average, where I'm not down in the trade at this point, really, after yesterday, after today, which is just, in my opinion, fantastic. I couldn't be happier. I've had these shorts on, which have mitigated risk for me in case this up move wasn't able to continue. Still had my longs on, realized the full profit potential of those longs, and haven't lost anything, even with those shorts moving that much against me. So, you know, the point of me saying that is that there are individual circumstances where it can be a little bit more difficult to kind of define it and say, hey, you know, very specifically, I'm doing what I just said, where I have this maximum loss based on a percentage of my account, and each trade that I'm taking is a percentage of that percentage. So I hope that helps, Jim. I really appreciate the question, and I appreciate you, you know, hanging out this week. From KP here, do you keep a daily profit or loss target before stopping trading for the day trade? Yes, on the downside, not on the upside. And this, I would encourage you to go back if you missed that afternoon meeting where we talked about this for like an hour, and then afternoon meeting. It was relatively recent. I don't remember which date it was specifically. I could probably try to figure it out, though. I don't like stopping on the upside. Don't like it. Going back to what I was saying before on what makes a trader profitable, if you never allow yourself to lose more than that $500, great, but if you never make more than $500, you're not going to be a successful trader. So if you stop yourself out at an upside target that's say +1 on what you're willing to risk in a day, you're never going to be profitable. So generally, I like strategies for reward maximization. Generally, reward maximization strategies are going to leave your upside as unlimited as possible. So cool, you're new to the group, welcome. You should have access to my training program classes. I recommend checking them out. Even really experienced traders tend to get a lot out of some of the classes. And one of the ones in particular that I get a lot of really good feedback on, which is actually the one that I'm going to recommend to you if you haven't seen it already, is my game planning class. And that's an hour plus class where I basically talk about reward maximization on trades. So yes, on the downside, on any trade that you take, especially if you're a newer trader, on any given day, that is the key to success in this business, is to have consistent discipline on that. And then the upside, you want to leave it as unlimited as possible. Next from Dennis. Once you have that realization you just explained about risk, the big question is, how can traders overcome these psychological hurdles about over-risking, the attachment to results, all of those inner obstacles, for sure. In my opinion, learning risk parameters, etc., probably much easier than getting to know yourself and working and adjusting your own psyche. In my opinion, awareness practice is one of the best tools for a trader to increase self-awareness and also to get into a really supportive mental state for trading. Do you meditate yourself? Yeah, so I 100% agree with you, Dennis. Learn yourself. And I also have an entire class on market psychology that I recommend to any newer traders to check out, where I talk about things like meditation and visualization. And I think if you can combine those practices with good journaling habits, it's a fantastic way to really learn about yourself. All traders have their own psychological strengths and weaknesses, and you need to know what those are. I've been doing trading for a while now. When I was younger, especially when I was younger, it even is still to some degree true, but I have worked extremely hard at this, and I've gotten better, and I think it's also just improved with age. I used to really struggle with emotional control as a new trader, especially back when I did a lot more heavy scalping type trading. So it's like super intense, and like a through print would come and trigger a stop loss that shouldn't have triggered, and I would go nuts and break a keyboard or whatever. I don't do anything like that anymore. But when I was in my 20s trading, there were times when I just absolutely lost my mind. And I was able to recognize that my biggest weakness as a trader was my ability to control my emotions. My biggest strength as a trader was always my discipline when it came to risk management. But my biggest weakness as a trader was always my ability to control my emotions. And I had to work super hard. And that came through meditation and visualization and journal practice. I needed to first learn the things that triggered me to lose control of my emotions in order to then be able to see them ahead of time and then to be able to combat them. And it wasn't necessarily P&L. I could have days where I was up money and lose my mind. I could have days where I was down money and lose my mind. There were actually other usually trade-based triggers that would cause me to kind of lose it. And if I lost it, that could lead to trading on tilt. It could be bad decision, leading to bad decisions. I had to also create rules for myself about if I did get on tilt, what do I do in that circumstance? So I used to have a rule for myself that if I, was hitting that point and I could see it coming and I was losing control, and this was when I traded 5 days a week at T3's old 1 State Street office. I used to have a rule for myself that at a certain point I needed to go downstairs and do 1 walking lap around the building that we worked in and the building next to it, and I would just kind of repeat a mantra to myself that it's only a stock, it's only a trade. I used to actually have taped on the top of my monitor the words, it's not personal, it's just a stock. Um, so that is what I did for a long time. I still believe that the number one counter to pretty much any bad psychological habit that I've ever heard from any trader is good game planning. If you have good game plans and the discipline to follow them, I think that can counter any other bad psychology that a trader has. But you have to have the discipline to follow them. That's it. You have to have the discipline to follow it. If your bad psychology causes you to exit winners too early, well, follow the game plan. If your bad psychology causes you to hold losers too long, well, follow the game plan for the trade. That's all you have to do. I know in practice sometimes it can be easier than that, but one of my favorite things to tell myself as a trader, I used to literally do this. So when I was a new trader, and I don't have any of the notebooks here, but I think I threw a bunch of them out, but in my apartment here in Manhattan, I definitely still have a few. I used to, as a new trader, and I worked my ass off as a new trader, I used to, so like I still post a watch list of potential trades. I used to hand write out the game plan that I would plan to utilize for any trade that I researched pre-market before the trade came along. So then all I needed to do, and I would literally tell myself this once the trade actually triggered and I was in it, just follow what you wrote on the piece of paper, stupid. That's what I would tell myself. That's all I got to do. I already all the work, and I love that Muhammad Ali quote, and I don't remember like the exact wording of it, but it's like one of my favorite quotes when he says that basically the fight is, he says it, Muhammad Ali very poetically, but he basically says like the fight is won or lost before you're actually under those lights in the ring. Basically what he's saying is that the fight is won or lost in your preparation for the actual fight itself. And for people that don't know, I actually am a retired professional fighter. I fought professional kickboxing for 10 years. I had 40 professional fights. I won 2 world titles before I retired in 2018. So it's an analogy that I always loved because it's 100% true. When it came to that sport, it was about the training leading up to it, and it's the same thing I think with trading. I think that most of my trading success comes from the work I do between 6 and 9:30 a.m. every day, actually. And then when the market opens, that's just game time where I am executing the plan. So whatever your bad trading habit is, just follow the game plan. And if you find that you're a trader who doesn't have a very specific game plan for every trade that they're in, you're setting yourself up for failure. One thing I can tell you for sure is that any position that you see that I have open right now, any position that you see me having open during the day, I have a very specific game plan for how I'm planning on trading it, and that is what breeds and creates consistent profitability. And if you don't have that, then you're opening yourself up to a world of psychological issues that I think it's going to be very difficult to counter those. I am not, I'm not a believer in like trading on feel at all. Even if there are times with my own trading when I struggle to put my finger exactly on why I think something is, there is something to the idea of, if you've traded for 10 plus years, that you have a certain amount of innate feel for the market. But even if you have that because you've been trading for a long time, I don't think you should trade on it, really. I think it's good to note it, but even if you're a super experienced trader and you can have feel, I don't think that doesn't create feel, doesn't create consistency. Game planning creates consistency. So that's my favorite counter to it. I no longer, you asked me if I meditate myself, and I'm always going to be honest in my answers, even as I recommend things to others. I no longer, at this point in my career, do a lot of the things that I did to get to where I am in my trading career. Just being totally honest, I don't journal anymore. I journaled forever. I used to write weekly journals on my Sundays, and I would spend 2 to 6 hours working on them. I don't journal anymore. I still keep statistics. I still keep data on my trading. I don't journal anymore. I don't really implement visualization or meditation practices around my trading anymore. I was talking to Dimitri about this in person just the other day. It probably took me, I don't exactly know, 8, 9, 10 years of trading to actually really feel what I say and what the goal is, which is to not be affected by your P&L, but to be affected by the approach. I can tell you at this point, sure, I'm a little bit happier and a little bit less happy based on if my P&L is nicely up or nicely down. But I can tell you very genuinely, as I trade throughout the day, I, I could care less what my P&L is. I think it was actually at one point today, I stepped away from my computer for a few minutes, and when I was walking back, I was trying to remember if I was up a few $1,000s in the day or down a few $1,000s in the day. I couldn't remember. I wasn't sure. It's still kind of flattish P&L to me at those price points anyway. But I don't know. I don't care. I really don't care what my P&L is intraday. I don't care what my P&L closes at the end of the day. I care about if I do the process right. And also at this point in my career, as long as I've been doing this, I do still make mistakes. I do still, I know I'm making a mistake if I find myself in a trade that doesn't have that clearly defined game plan like I was just talking about. That happens still sometimes. I'm very, very hard on myself when I make mistakes at kind of this point in my career. That's what I really, really beat myself up over. Otherwise, I don't care what my P&L closed at the end of the day. I know that I just need to come in and do my repeatable process over and over and over and over and over again, and then I'm going to make money. So today really doesn't matter. But like I was saying to Dimitri, and like I'm saying to you guys now, it probably took me 10 years to be able to get to that point. But it's another thing that really helps from a psychology perspective. Many of us, our psychological trading issues are rooted in seeing what our P&L is at any given point in the day. We're up, we're down, I'm near my lockout, I'm near my limit down, I'm going to trade differently because of it. I'm up money, I'm going to trade differently because of it. I trade the exact same no matter what my P&L is. And if anything, and this actually has been a problem that I've gotten better on in the last year or two. If Bill's still listening, I know he's been around long enough to see me do this, and we've spoken about it. I trade best when I'm not doing well, because I become hyper disciplined with my edge and my game plan. I sometimes make mistakes. We call it being profit drunk, when I've been doing too well and I've been making too much money, and I start thinking I'm like invincible or whatever, and then I just start getting involved in things willy-nilly without game planning properly or managing risk properly. I'm really happy to say I haven't done any of that in November this month, and it's been a really good month for me this month, and there's been zero profit drunk trading that's been happening this time around. Yeah, maybe that's been another thing I've always tried to figure out over the years, is being sick actually helped me with my trading in certain ways, or another one is being hungover. I have found that there have been days where I've been hungover and I've traded so well, and bottom line is you probably shouldn't be getting hungover. It's super unhealthy for you, and we know how unhealthy alcohol is, and don't play with fire. But there's also been days where I've been hungover and I've traded like a complete and utter jerk, just like pressing buttons. Okay, Josh. Cool. I appreciate the question, Dennis. I hope we got through it. From Rich, how would you psychologically characterize and value our individual Friday night spreadsheet sessions there, champ? I still do that once in a while. I still do that once in a while. That was hugely beneficial for me at points in my career. So Rich has also been on the team for a very very long time. Rich, what year did you get started with T3? I know it's been a long while now. So Rich is great because he loves to throw out questions every once in a while since 2015 that he knows the answer to just because he thinks it could be good for other people. Um, a really cool thing that I encourage newer traders to do, or even not newer traders, and I still do it myself sometimes, that I think has been really beneficial to me in trading is to play with game plans. So, the background on it is back when I was fighting professionally, Friday night was my big sparring night. The main reason why we don't do afternoon meetings on Fridays, and I've just kept it this way even as I've retired, was that I would have to get out to the gym to spar on Fridays, and I didn't have time to do an afternoon meeting on Friday. But now I like just having the freedom on Fridays. What I used to do back when I was, training for fights and everything, my entire life revolved around training for fights and trading. That was all I did. No social life, no nothing for a long time. And what I would do after I would finish my sparring session on Friday night, if I wasn't in training camp, I would grab a beer. If I was in training camp, I wasn't allowed to drink. I would open up the computer at 9 p.m. on a Friday, possibly with a beer, and I would open up a blank spreadsheet and I would just play with potential trading game plans and see what the P&L would look like with different risk amounts and different entry amounts and building into positions and building out of positions and doing it in different ways. And I genuinely enjoyed it, to be honest. It was fun for me. And it was also really, really productive. If you have an idea of, hey, I want to try this type of trade, or working on this type of trade, or whatever it is, sit down with a blank spreadsheet without the charts, without the noise of the P&L, without any of that. Sit down with a blank spreadsheet and just review the numbers. This is what my entry point would look like. This is what my stop loss would look like. This is how I want to build into this type of position. This is the type of sizing I want to be able to get to. This is what I want to be able to do. If it's moving in my favor, should I sell 50% of my position at 1-to-1 on my risk? How do I want to trim? How do I want to trail? What do I want to do in each circumstance? And just play with all that. Find game plans that you think can, maximize what you're doing for your approach, and then learn those game plans so well that they become second nature, so that, going back to bad trading psychology and everything else, come in and take your trades and just follow the game plans that you have in the back of your brain like nothing. I'm at the point where I'm always trading during the day. I've always got positions open. I can be on the phone having a conversation with someone, or be on like a Zoom meeting, and it's likely that I am placing trades during that conversation, and you will not have any idea that I was doing it, because I won't skip a beat on the call, because my game plans are so ingrained in my brain that I just know, oh, I got filled on this bid, so that means I need to put this offer out. And I'm focused on the conversation. I'm not focused on the trade, because I already know what the game plan is for the trade. I got filled on this bid at this price, therefore this offer goes out at this price. And it's just like second nature. So game plans are really important and key to success. From Mufasa, risk management is tough. What will you say to people who hold losing positions longer than they should? In most cases, even longer than winning positions. Yeah, again, if you're holding your losing position longer than you should, one of two things is going on. Either one, you didn't have a game plan for how you're going to manage risk. Well, you need to have game plans for your trades. Or two, you didn't have the discipline to be able to follow that game plan. That's a much more difficult thing to get through. And how do you build for yourself the discipline to follow the game plan that forces you to manage risk properly and get out of losing positions when you should, is through all the practices that we just discussed. Journaling, review of trades, and hindsight. People hate on hindsight. I think hindsight in trading is a beautiful thing. Hindsight's 2020. So you go back and you look at things in 2020 vision in hindsight, and you can see how things should have been perfectly, but then keep that for next time, because things repeat. You know, meditation, visualization, journaling. If you go back and you do monthly journals, which I suggest, and you do the P&L exercise I talked about before, where you look at every single time you lost more than $500 or whatever your maximum loss is, and then you're looking at your month and why your month is negative, and you realize it's because of those 3 trading sessions where you had no discipline. For me, that's reinforcing that I need to day in, day out do the right things. Mistakes will still happen. They still happen. But progress is in making those mistakes lesser and fewer over time. I got one question from Gabriel on the YouTube. Do you think that the trillions of dollars in money market funds will slowly deploy into the market to keep a bid? I haven't seen an updated money market fund chart recently. I think it's still hit even new highs last I saw relatively recently. I think that money is going to move into the equity market. I really don't know the answer to that. Pat's morning meeting somewhat recently had a whole thing about it. We're not in an environment anymore where people have no other choice, you know, so they can be involved in bonds. They can just deploy strategies in other ways. I don't think we're going back to 0% interest rates anytime soon. Even if the interest rate situation does decline a little bit, I don't think that we're going back down to 0. So it's one of those things that's always notable, the money that's in those funds, but I don't think it's necessarily actionable. And I think that a lot of the data showed that a lot of the money that moved into money market funds didn't come from equities to begin with. It came from checking and savings accounts. People who have their checking account getting no yield saying, oh, let me just move it into money market funds because it's still very liquid and I can be in and out. I don't think it's necessarily money that came out of the equity market into money market funds, so it doesn't necessarily have to come from money market funds back into the equity market. Thanks for the question, Gabriel. All right, gang, this was a fantastic afternoon meeting. It's 5:30, so this is a good long one. Hope everybody had a great day. Hope everybody's learning a lot. I hope the guests that are here especially are enjoying it. And I'll see everybody tomorrow morning. I'm going to the Knicks game tonight. This is going to be like the second time I've ever seen live basketball, professional basketball, maybe the third time ever. So it should be cool. I don't know anything about anything when it comes to live sports, to be honest.
Yeah, they shoot for touchdowns.
They shoot for touchdowns. Yeah. I can't name 3 football players, but yeah, I'm going to the Knicks game tonight, and I love, even though I don't follow any sports, I love live events. So, and I know the rules are bad. Yeah, I used to play some decent pickup basketball back in my college days. I bet that I would still beat you in a one-on-one, Josh. That sounds like a challenge. Have a great night, everybody. See you tomorrow.